everybody, it's just Amy here from Consortium Private Wealthy in Horsham. I just thought I'd do a quick video today on the rising cash rates. The Reserve Bank of Australia have recently risen it by 0.5% again. Just getting a couple of questions about what the cash rate is, why it is rising, and if there are ways to prepare for future rises. So what is the cash rate and why does it exist? Just a bit of background, the Reserve Bank of Australia, also known as the RBA, set the cost of money in an attempt to stabilise the economy. So they can do this in a couple of ways. They can increase the cash rate, maintain the cash rate as it is, or decrease the cash rate. When they decrease the cash rate, it stimulates the economy by encouraging spending. This is what we've seen in the last couple of years, a very low cash rate, which means low interest rates. People borrow more and the economy does well. They can also increase the cash rate, which slows down the economy as it tightens people's household cash flows, and this is an attempt to decrease inflation. Obviously, we're all experiencing very high inflation at the moment, so hopefully by increasing the cash rate, people are putting more of their money into repaying loans that they have and spending less on consumer goods. Now, the RBA meet on the first Tuesday of every month, and during this meeting, that is when they decide whether they're going to increase, decrease, or maintain the current cash rate. So this means that there's another 5 months left in the year. We could see potentially 5 more increases to the cash rate, as we've been told to expect more. Now, there's a couple of ways that we can prepare for these increases in cash rates. So I'll go through those ones now. One great way that we can prepare for an increase in rates is to apply a stress test on any loans that we may currently have, or loans that we might be taking out in the short term. The big banks do already do this when you do apply for a loan, so they have to put 3% on top of the advertised rate. So if you're going for a loan at 3%, they will apply a 6% loan on the duration of the loan and assess whether you have the capability to repay that. But a good thing to do at home is also apply a similar stress test. So calculate how an increase in interest rates might impact your budget and household cash flow. Another way to prepare would be to opt for a fixed rate loan. This would be a really good option if you just like the certainty for the fixed period to help with your budgeting. Fixed rate might be the way to go. Even with a fixed rate loan though, you need to remember that at the end of that fixed period, the interest rate may still go up. So don't rely on that rate for the entire 30-year loan or whatever your duration might be. Another tip on how to prepare for an increase would be to make sure that we are minimizing other sources of debt that we might have. In an environment like this, when there is so much uncertainty and such a high threat of an increase in rates, we really don't want to be overstretching ourselves with debt. So definitely apply that stress test to yourself, and if you find that your budget is struggling, just consider taking out a smaller loan. We definitely don't want to be borrowing more than we can afford, because it just makes our lives stressful. Having to worry about if we can afford repayments the next month isn't the way that we should be living our lives. That's all from me for today though, so hopefully that was of some value to you all. If there's anything else you'd like to see, please leave a comment below. Otherwise, we'll see you next time. Bye.